Welcome back to our pre-budget special, What the World Wants from India. Let me now welcome Robert Marshall-Lee, the head of Emerging and Asian Equities at Newton Investment Management, which is a part of BNY Mellon. Robert, thank you very much for joining us. First up, a word on India vis-a-vis emerging markets. Until now, India stood out in the EM basket. It was often called the good house in a bad neighborhood. Do you still see India that way?
I think so still. We've been long India since 2011-12. Still see no reason to change that. In the shorter term, it's quite well held by international investors. So it's no surprise to see the stock market correcting a little bit, and particularly in the run-up to the budget. But if you look for growth around the world at the moment, it's a pretty rare commodity. And India is just emerging from a credit cycle. It's still a bit tricky. The earnings are a bit all over the place, so some good, some bad. But I still think in terms of where you're going to find well-underpinned structural growth driven by economic reforms, improved access to credit, and just coming from a low base, so from depressed margins and so on, I think India has plenty of potential. And then, of course, you have the demographic factors, the potential for catch-up productivity and so on top.
Yes, actually, Robert, when you last spoke to us, you had 30% of your EM equity fund invested in India. Is it still the case that way? And which are the sectors you're invested in?
It's about 30% of the portfolio. Yeah, so 20% overweight, and that remains very consistent. Haven't changed things very much. We still remain very tilted towards the consumer stocks. We haven't been too heroic, so we don't hold that much in the banking sector. Although we do see opportunities in some of the private sector banks, we still steer clear of the state-owned banks, the PSUs. But we haven't been heroic in terms of investing in lots of infrastructure companies at some of the more highly geared situations. Instead, we keep that focus on the consumer, and that's, as we see a grind out recovery, that's where we would prefer to be. The consumer has broadly been rebuilding their balance sheet, and I think also you have a lot of good quality companies who are still making decent profits at the bottom of the cycle, but with good potential to grow from here.
What about sectors like infotech and pharmaceuticals?
We have one or two exposures there. Quite happy to hold on to them. So the highest quality ones amongst the IT companies still remain good companies for the long term, well managed, high return on capital. So yeah, we were quite happy to have an exposure there to specific ones. The only downside is, of course, there's been a lot of cutting of expenses in the banking sector in the Western world. And that's one of the key client bases, so it's a short-term problem. Longer term, there's obviously the transition to the cloud, and that is ultimately a potential threat to these businesses, but actually in the next 5 or 10 years it could be a great opportunity for the Infosys and TCSs and so on of the world to actually help that transition, help companies to go through that. They're actually well positioned to do that. On the pharmaceutical side, it's just very specific. So we like companies which are not purely reliant on generic penetration into cheap markets. We like some companies with some innovation, and actually see quite a bit of value in some of those stocks right now.
Okay, now coming to the annual government budget, which will be announced on Monday, what are you looking forward to in the budget?
Not too dramatic a shift, really. I mean, I think the shift from paying out lots of subsidies and towards more expenditure on long-term growth drivers, so more expenditure on infrastructure, I think is very important. So we don't want to see too much of a shift from that. It's been good to cut down those subsidies to make the fiscal situation more sustainable, and then redirect it towards the coal sector, the roads and so on. That's a very good thing, the dedicated freight corridor. So we'd like to see more of that. I think in the real world, the rural consumers have clearly been suffering from the reversal of some of the subsidies there, and Rega, etc. So I think politically it's quite possible to have a bit more of a push from that. In terms of the pay commission, we know broadly what's happening there. The question is really more about the timing. Whether we see a one-off move or whether it's spread over 2 or 3 years. I think we'd like to see it spread over a couple of years, and then just want to make sure the shop's kind of kept reasonably secure. We don't want a dramatic shift in too many things. That said, India does have a bit more room for manoeuvre, particularly with the oil price falling back so far. So with that in mind, I can see a bit more kind of wiggle room for the government there.
Well, the government is supposed to stick to a fiscal deficit target of 3.5% of GDP. Is that number very important for you?
It kind of depends how they're spending the money. I mean, if it's just in terms of rural handouts and so on, and it's a bottomless pit aspect, that's obviously more concerning. If they're putting more into the growth drivers and fairly kind of sensible expenditure, it's a little less concerning, because ultimately there's a payback on that. It helps to drive that GDP growth to stimulate things. Obviously, the recapitalisation of the banking sector is a matter which is dear to everyone's hearts. It's clearly been the fly in the ointment for us. And so we'd look for the government to give a bit more in terms of signposts about what they're looking to do with the banking sector, because clearly that's the kind of the brake on the economy at the moment. We're seeing very strong credit growth coming through of the private banks, but the public sector banks are clearly constrained by their balance sheets and by the NPL recognition issue. Now, I think it's a very good thing that they're recognising those NPLs and bringing those into the sight of the market. But at the same time, you need a recapitalisation mechanism. Bad bank has been mooted. That's just one way of doing things. The key is to kind of not avoid the moral hazard. We want to keep the promoters on the hooks where they've made bad decisions historically. But at the same time, we want the banks to be free to go out and lend capital to sensible projects, to sensible users of that capital going forward.
Is there any particular recapitalisation figure that you will watch out for in the budget?
I think the key is that they try and keep a route there for the private sector to participate as well. But the private sector needs to understand what they're buying into and at what price. And sometimes people are politically nervous about raising capital at a more depressed price-to-book ratio. But actually, if you're doing that, then you're actually improving the incentives for people to come in and recapitalise the banks. So I think the key there is not to be too precious about that price-to-book level when recapitalising the banking sector, and allow the private investors to come in and help the government out. Because the government doesn't have the full room for manoeuvre to do something like that in one fell swoop at least. It would take quite a long time. And in the meantime, of course, that continues to act as a brake on the economy in terms of fiscal revenues and so on. Yeah, as you say, I mean, I think the number mooted by the government is insufficient, but the key is that they provide the mechanisms to do that. The alternative, of course, is to have some kind of bad bank. That in itself would still need capital to be formed, and then there's obviously the dispute about what price they pay for those impaired loans, which is a whole other kind of question.
Robert, what's your own take on this Reserve Bank goaded effort to clean up bank balance sheets? Was it ill-timed or too rushed an effort?
No, I think that's a very good move. I mean, everyone knew that a lot of these loans were sitting there on the balance sheets not performing, and so it's better to have the visibility than not have the visibility. And you only have to look over at China and the Chinese banks and how investors behave towards them to understand the alternative approach there. It's not a good thing, and you don't get rewarded for that. The key is we just want the credit mechanism to be in place to help drive the economy forward. We want to have that route for the private capital to make it into the market and for the savings to be recycled. There are plenty of savings available in India, so let's try and get that across. But if you don't have the capital base, it's much harder to do so. The banks still feel nervous. They need to kind of try and protect their balance sheets.
Are private sector banks attractive to you now at their current valuations?
Absolutely. I mean, again, we're stock pickers at the end of the day, and we try and find the best ones. But some of the share prices have really been pummeled on the back of this. It's good to get this kind of clean up out of the way. I guess there are some banks where you have more confidence that has happened, and somewhere we're still a bit nervous that we haven't seen the full extent of the underlying problems. And it remains to be seen. I mean, sometimes these skeletons come out of the closet a little later down the line. So the cleaner the bank, the better. Some of the mortgage lenders, for example, could be a better place to hide with that in mind, because they're less likely to have the lumpy problems. At the same time, we've seen power sector reforms which could actually remove some of the NPL issues the kind of the restructured loans which have just been not paying out the cash because the cash hasn't been coming out of the assets behind them, but actually they have perfectly good assets. So now that the government's giving the potential for the power assets to start generating the cash, perhaps some of those effectively stranded assets start performing, and that in itself should alleviate some of the stretch on some of the balance sheets.
What are your expectations, Robert, from the Reserve Bank with respect to interest rate cuts or the rupee?
I think the two things go together. I mean, if the government is a bit more profligate, if they spend a bit more money, try and pump prime the economy a bit through the fiscal mechanism, then you can expect the RBI to be more restrained, less likely to cut rates. If the government is more restrained on the fiscal side, then the converse is likely to be true. You might well see 50, 75 basis points of cuts still to come out of the RBI. So I think it really depends. I mean, I have to say, the RBI has been very sensible to date. It's got a very good name in the markets, and we just look for that to continue. I think they're pretty well balanced.
Well, that's cautiously optimistic. Robert Marshall-Lee, thank you very much for joining me in our special pre-budget series, What the World Wants from India.